There are thousands of ETFs out there, and most of them will just confuse you, waste your money, or even cost you hidden fees. But if I were starting from scratch today, there's only one type of ETF I'd invest in as a beginner. I'll also go over what not to do, and trust me, you really don't want to make those mistakes. Beginners don't need dozens of ETFs, and they shouldn't. You really only need one type, and that's what we're going to cover. An ETF, or exchange-traded fund, is basically a basket of investments you can buy like a single stock. Instead of buying Apple, Amazon, and Google separately, you can just buy one ETF and instantly own tiny pieces of all of them. It's like buying the entire grocery basket instead of grabbing items one at a time. But here's the catch. Not all ETFs are created equal. Some focus only on one sector, like tech or energy. Others are way too risky, like leveraged ETFs that swing wildly up and down. And plenty of them charge high fees that quietly eat away at your returns. As a beginner, these are traps you really don't want to fall into. So which ETF actually makes sense? For beginners, I would only invest in broad market index ETFs, like an S&P 500 ETF or a total market ETF. They give you instant diversification across hundreds, sometimes thousands of companies. They also come with extremely low fees, often less than 0.10%. They're one of the most reliable ways to grow wealth over the long term, so you can rest well at night knowing your money is working for you. With just one investment, you're buying a slice of the entire market. For example, if you invest just $100 in an S&P 500 ETF, you instantly own a piece of Apple, Amazon, Google, Coca-Cola, and hundreds of other companies. It's like owning a slice of the entire US economy, all from a single purchase. So if you're looking for your first ETF, here are 3 things to look out for. First off, you need to keep your expense ratio under 0.10%. This is basically the fee you pay every year to own the fund. A lower number means less of your money goes to fees and more stays invested and growing for you. Anything above 0.10% is usually not worth it for beginners. 2. Go broad with something like an S&P 500 or total market ETF. These funds give you exposure to hundreds or even thousands of companies in one shot. That way, you're not betting on a single stock or narrow sector. It's instant diversification, which lowers your risk. And 3, stick with big, trusted providers like Vanguard, iShares, or Schwab. These companies have been around a long time, manage trillions of dollars, and are known for keeping costs low. You don't have to worry about your ETF shutting down or dealing with any hidden fees popping up. Now, let's talk about what not to do. Don't chase flashy niche ETFs like AI or gaming. They're risky and unpredictable. Don't day trade ETFs. They're designed for long-term growth, not quick flips. And don't ignore fees. Even a 1% fee can quietly drain thousands of dollars from your future wealth. So stick to a broad market index ETF. It's simple, cheap, diversified, and proven to grow wealth. If this helped make ETFs clear, please make sure to subscribe for more finance made simple.